Good afternoon, everyone, and welcome to today's webinar on value investing. My name is Audrey Melville, and I'm the marketing director here at Gabelli Funds and your moderator for today's session. I'm thrilled to be here today with my colleagues, Chris Marangi and Kevin Dreyer, who are our co-chief investment officers of value here at Gabelli. For those of you that aren't familiar, Gabelli is an asset management firm founded by Mario Gabelli in 1977. And today we manage over $30 billion in client assets across a broad set of asset classes, investment strategies, and vehicles. So we're excited to discuss how traditional value investing principles are faring in today's volatile market and what opportunities are emerging. We will also make sure to save time for Q&A from the audience, so feel free to pop your questions into the Q&A box and we'll be sure to get them answered. So to kick us off, I'll let Chris and Kevin go ahead and introduce themselves.
Sure. So I'm Kevin Dreyer. I'm Co-CIO of the value team here at Gabelli. Been with the firm for 19 years, joined out of Columbia Business School, as many of us did, as a consumer analyst, obviously now following kind of everything, though that's still near and dear to my heart.
And I'm Chris Marangi, another co-CIO for Value here. I joined 21 years ago as a media analyst. Also came from Columbia Business School, prior to which I was in investment banking and private equity.
Great. Thanks for taking the time to be here with me today. So before we dive into kind of the current state of markets and value investing, can you provide a brief overview on the history of value investing and discuss our value investing philosophy here at Gabelli?
Sure. So most people trace value investing back to Ben Graham and David Dodd with security analysis in 1934, later evolving with Roger Murray, Bruce Greenwald on the academic front, and most importantly, Warren Buffett, who expanded the notion to invest in good companies along with Charlie Munger. It really started just with this idea of we want to buy a business at a value that's less than what it's worth, as opposed to a piece of paper just to be traded, and then trying to find various ways to determine that worth. Back in Ben Graham's day, it was all about nets, so companies really trading at less than their cash or liquidation value. Don't find as many of those today, but where we are in value investing is we look for good businesses, but what our unique style is called private market value with a catalyst. And this is something that Mario really pioneered in 1977. What that means is we try to determine the value a business would be worth to a private buyer, whether a private equity firm or a strategic buyer, and then looking for one or more catalysts that can surface the value, things like M&A, financial engineering, or some other means.
Great. That's a helpful overview kind of on the history of value investing. And so how has the landscape changed from the Graham and Dodd days to today?
Yeah, so Kevin outlined the basic tenets of value investing. So one of the more important ones is this notion of intrinsic value, what we call private market value. And what's really changed, I think, is how intrinsic value or private market value is estimated. Obviously, back in the days of Ben Graham, he looked at the Moody's manual of railroad bonds, for example. Now we've got lots of different sources of information available, and that can make determination or estimation of private market value more difficult or easier. Certainly a lot more information, but there's a lot more noise. And part of the job of our analysts, as they're doing fundamental research, is to distinguish the noise from the signal. Our process here is called GAPIC. Gather, array, project, interpret, communicate. That's the mantra that we use. Ultimately, it goes to developing a set of cash flow projections, which go into estimating private market value, which is really ultimately derived from what, as Kevin mentioned, informed buyers have paid for actual businesses in the real world.
Great. That's helpful. In 2024, we've heard a lot of talk about the Magnificent Seven and growth stocks. And so what sets value investing apart in today's market conditions compared to some of those growth-focused strategies?
Yeah, first, I just say that I think too often growth investing gets conflated with momentum investing. They're different. Certainly the way our growth team here at Gabelli practices growth investing is based on fundamental research. And really, I think it's a matter of emphasis, whereas the value investors are typically looking to pay 70 cents for assets worth $1. Growth investors might be willing to pay something closer to $1 for something that will be worth $1.30. in a few years. So we're really kind of focused more on the here and now. We like growth. We like growing companies. We're not allergic to growth. We just want to pay the right price for it.
Great. That makes sense. How have inflation and high interest rates been impacting value stocks recently, particularly in any key sectors? And then, of course, just a few moments ago, we heard that the Fed has just cut rates for the first time in 4 years. And so how will that kind of impact how you have been thinking about value stocks recently?
Yeah, so the whole inflation and rates dynamic have dominated markets over the last few years. When you go back to when inflation first started, and especially when the Ukraine war started as well, this big run up in oil and a lot of commodities. So from the perspective that those are seen as quote unquote value stocks, that really propelled that part of the market. As inflation's made its way throughout the economy, what it's really forced companies to do is, to see how good their pricing power is, to get that through. That's always been a very important thing for us to look at. It goes back to our founding in the late 70s and early 80s, which was really the last period of high inflation we've had in this country. So we're really biased towards these strong cash flow generating businesses that do have pricing power, whether it's a waste collection firm, some consumer branded goods, certain cable companies, et cetera, that can raise prices above costs. Now, it's not always in a straight line. So as inflation goes up a lot, there's pushback from consumers, there's pushback from politicians, which has happened a lot recently. So very often companies will have to eat it on some level initially until those costs level off and start to go back. But I think it really goes to the fact of that looking for those core good businesses that can deal with that situation is very important for us.
Great. And how do these macroeconomic trends that we're discussing typically affect the performance of value versus growth?
Oh, and maybe also just to jump in on the rate cut before we get to that. Now we have the rate cut that's been announced, just before this started, 50 basis points. And it's funny, we were talking about this before. I'm not sure that we knew what the market reaction would be, because it might show that the Fed's more worried about the economy than everyone else is. On the other hand, it will lead eventually to economic growth again and maybe engineer us towards the soft landing. So from that perspective, I think on a go-forward basis, it does lend itself towards a little more pro-cyclical type companies that do have economic exposure, which happen to be a lot of what people call value stocks, and certainly stocks within our portfolios.
Great. That's helpful. And an interesting reaction to the news. So when we're talking about these, things like inflation and high interest rates, how can we expect them to affect the performance of some of the value stocks that you guys look at versus some of the growth stocks that our growth team is thinking about?
Yeah, so it's been a little bit of an unusual situation over the last couple of years as we've started this rate hiking cycle. In theory, higher rates should more negatively impact companies with longer duration cash flows. Those are often growth companies. Those are in many cases the companies that make up the Mag 7. But in reality, those companies have been among the best performers. And I think that's for a few reasons. One is these Mag 7, even though they are growing companies, I think have been viewed rightfully as safe havens. They've got fortress balance sheets, often net cash, typically great businesses, and with secular tailwinds, particularly in artificial intelligence, that outweigh a lot of the cyclical and other concerns that we have in the economy. So they've done quite well. Now, they probably in the near term will do not quite as well because of the reasons that Kevin mentioned. As we get to assuming we have a soft landing, which I think the market is pricing in today, smaller companies, more cyclical, more leveraged companies that typically comprise the value benchmarks in our portfolios should do relatively better.
Great. That's, I think, a good way to set the stage for what's going on in the current landscape. So just because you both have so much experience in this space, I think it'd be helpful to take a step back and kind of look at historic market cycles and how you think about navigating market volatility. So are there any lessons or learnings from previous market cycles that have informed your investment approach for managing recent levels of volatility?
So first, I just would pick up on the words that you used there, which is volatility. And we don't necessarily equate volatility with risk, even though a lot of people do. Volatility can be good or bad, and I'll come back to that. But really, the way we think about risk is the chances that capital is going to be permanently impaired, or that the earnings power of the underlying company is going to be permanently impaired. And that really has to do with balance sheet and the financial flexibility that each company has. We started managing client assets, or I started managing client assets in August of 2007, right at the cusp of the great financial crisis, which was pretty formative time, obviously. And you know, we dug deep into each company's balance sheet, to their covenant situations, and we wanted to make sure that every company that we owned would be able to make it through what was at that point an unknown situation. And that was pretty much true across the board. So we are paying attention to things like financial flexibility and balance sheets. And that's a sort of a table stakes for getting into the portfolio. In terms of volatility, volatility can be a good thing. That allows you to sell dear stocks. It allows you to buy cheap stocks. So, you know, as long as you have a long-term perspective and are able to stomach some of that volatility, the daily movements up and down, ultimately can lead to better returns.
Great. That's helpful insight. And so specifically when we think about industry or sector specifics, what are some of the sectors that have proved resilient amid market volatility in the past?
Yeah, I mean, traditionally, when we talk about volatility, especially talk about downside volatility, resilient sectors have been thought of as healthcare, utilities, and consumer staples. So, you know, those less economically sensitive sectors. The whole inflation dynamic has impacted consumer staples a bit, especially food stocks, just as that's been a little more difficult for consumers to, you know, pay up for those with the price increases. So there's been a little bit of rationalizing going on. At the same time, on a go-forward basis, we might see a little more eating at home as well, which could offset that going forward. But those are really the sectors that have been historically the most defensive, with the caveat that, as Chris just said, some of the Mag 7, even though their growth stocks have been, you know, acting as defensive stocks in some cases.
Great. And so is that informing today's investment decisions? Are you still looking to those sectors as, you know, being safer, or are you anticipating other sectors that might prove interesting?
Yeah, so we don't really invest that way to say, you know, let's identify sectors that are going to be safe if everything falls apart and invest in them, or, you know, go all in for recovery. We're really bottom up. We're really stock specific. And for us, the question is always, what's the earnings power of this business today? What's it going to be 5 years ago, 5 years from now? What's our upside? What's our downside in that stock? Do we have a margin of safety, and are there catalysts there to surface that value? Now, that being said, we do have investments in all of those sectors, you know, often largely for those stock specific reasons. But we've got a lot of more cyclical and economically sensitive stocks as well as, and we also, in certain areas, we like sectors with long-term tailwinds, like aerospace and defense, for instance, just due to plane demand over the next 30 years from around the world, as well as increased military budgets due to all the geopolitical tension. That's an area, you know, with a lot of tailwinds behind it, and we've got a lot of stocks, a lot of, you know, especially in the small and mid cap area there, that we like in that sector that are at attractive valuations right now.
Got it. And so keeping all of that in mind, how can investors prepare for prolonged periods of market volatility?
Well, just, I guess, first from the perspective of the portfolio managers, you need to know your stocks. You need to find stocks that have a margin of safety, and you've got to have a long-term perspective, which doesn't necessarily mean that you're not nimble and not watching, you know, every tick of the market. It's just being afraid to do nothing, which is sometimes the hardest thing to do. From the investor's perspective, again, it's about knowing your own risk tolerance, and as we say, being comfortable and knowing where your sleeping point is. Means probably having a diversified asset plan, but sticking with that plan over time.
Okay, great. And I know we've touched on briefly the private market value with the catalyst approach at Gabelli. And obviously one of the catalysts that we often talk about when surfacing value is M&A. So moving over to discussion around M&A activity, how can we think about interest rate cuts and how rate cuts historically affect M&A, particularly in small and mid-cap sectors?
Yeah, so as far as M&A, rate cuts are very good for it. Just from the financial decision, whether when you're a company, you're looking at acquiring another company, it's going to make that hurdle rate lower to acquire another company. So the buy versus build decision certainly lends itself more to buying. I think more broadly within M&A, you've got private equity, which was kind of on the sidelines a bit over the last couple of years, has been ticking back up. This year, it could make private equity a lot more active because unlike strategic acquirers, even though sometimes they'll have portfolio companies that they can combine a target with, they're not going to generally have the synergies that are there to offset. But M&A rose a lot as interest rates were very low, declined as it was rising. Now we know the bell's been rung, rates are going to be coming back down. I would definitely expect M&A to accelerate from here with the caveat that we do have an election coming up and that could have some influence as well.
Yeah, just to expand on that, we've seen a pullback in M&A over the last couple of years for a few reasons. One, of course, it's been a difficult regulatory environment, particularly in the US. That may change. And obviously, financial liquidity or availability of capital has been less to the extent that interest rates and changes in interest rates are a reflection of availability to capital. Lower rates probably are a good thing. I think there's also an element of signaling and boards thinking ahead, maybe postponing M&A until we get a better look at what the regulatory picture looks like or what the interest rate picture looks like. And as we get more certainty, a lot of that pent up demand for acquisitions is going to get unleashed.
Yeah, and we've actually heard this commentary specifically from some of our companies in looking at their own M&A. Amitech, for instance, which is based in Berwyn, Pennsylvania, outside Philadelphia. Recently, they've been saying for both customers launching new projects that use their products, but also on the M&A front, that a lot of people have been waiting just to see what happens with all this uncertainty around both when are we getting interest rate cuts and the election. So whatever the outcome, I think it's just the certainty that, okay, now the rate cuts we know are here, and whatever the outcome of the election, then at least that'll be a known entity that you have to deal with one way or another going forward. But still, I think that the rate dynamic outweighs the political one when it comes to this.
Yeah, and the pace of change in the world has probably accelerated over the last several years, whether that's because of geopolitics or especially because of technology. And so, companies in many cases either need to buy growth or there needs to be industry consolidation, rationalization to make new economic models work. That's true in an area that I focus on, and particularly in media, where there, I think as people who are watching this may agree, too many streamers, too many streaming services available. There probably needs to be some consolidation in that particular area, more scale to compete with the very large tech companies. We've started to see some of that happening, and again, would expect more, which we think benefit many of the companies that we own.
Yeah, and similar dynamic playing out in consumer, where again, some of these companies have struggled a little bit over the last couple of years with all the price increases needed and some pushback from consumers affecting volumes. But we did just see a pretty big deal announced in August. Mars, which is private, buying a company called Kellanova, former Kellogg. They had done financial engineering to split off their cereal business. And they are primarily in snacking, one of the more attractive areas within food over the last few years. But nonetheless, paying a pretty big multiple, over 16 times trailing EBITDA, kind of highlights the value of other snacking assets and food assets generally. I think the question is this going to lead to another round of consolidation in the industry? We read through some of the merger documents and see that there were some other companies looking for either the whole thing or the pieces. So I'd stay tuned for more consolidation in that sector. And I'd add, they gave a playbook of, speaking of catalysts, not just M&A, financial engineering, doing the spinoff, WK Kellogg, the cereal business, which has actually done quite well since the spin came out at a very low valuation, and Kellanova, both stocks have done terrific. Look around at other companies in the industry like Campbell Soup, which just had an investor day last week. For instance, they have a meals business that's a little slower growth, even though now they have Rao's pasta sauce. And then they have a snacking business as well. So it's set up very similar dynamic to what Kellogg was like. I'm not sure if they will split it or not, but I think it's an option that they now, could end up following.
Interesting. A lot of interesting M&A dynamics. I, for one, would really appreciate the consolidation of the streaming platforms. But so a couple of things to follow up on there, but just one that came up a lot was the election. And so, how could the outcome of the election impact M&A activities?
Yeah, well, other than, potential change in the main regulatory agencies, including the Federal Trade Commission and some of the specialized agencies like the Federal Communications Commission, we're looking at other things like tax policy, which, impact M&A. Does the potential increase or the failure to extend some of the tax cuts in 2026 lead owners to sell businesses faster, to move up capital distributions, et cetera. So I think either way, we're going to see an uptick in activity. But obviously, the election is going to disproportionately impact some industries, obviously, particularly highly regulated versus less regulated ones. But again, we take all that in consideration when we're evaluating a particular investment. And for ones that are subject to significant regulatory overhang, we're going to look for a bigger margin of safety before we invest.
Yeah, and I think, another Trump administration would probably be viewed as a little bit friendlier to M&A. Whether that's the case or not remains to be seen. I mean, last time they did challenge some deals as well, so it's not like they would just let everything go through. And at the same time, current administration, some deals have been challenged that they've won in court. We've got some going on right now, actually. So yeah, I think overall, it's with the caveat about what Chris said about taxes as well. I think it's the economic situation and the rate situation is going to, really be much more important.
Got it. That's helpful. And you also mentioned potential accelerated M&A activity. And so would the acceleration of M&A benefit certain sectors more than others?
I'm not sure I see, we called out a couple sectors already that are ripe for consolidation. I think certainly now with the rate cuts, companies that are going to be doing better in, let's say, 2-3 years time in a recovering economy, whether we go into a recession or not, or this avoids one, the notion that we should be going to hopefully a higher growth situation. So a lot of those industrial companies, some of those aerospace suppliers, there's been some M&A within that sector already. We could see more of that. So I think, those kinds of companies might be a little more prime to be bought out, but I kind of expect it across the board.
Okay, great. So going back to the rotation from growth to value and small caps, what are some of the driving forces behind the shift from growth to value?
I think number one, it's just very overdue. I mean, it's been a very long growth/momentum led market. Some of that has been led to zero interest rates that we've had on and off now for a long time. Some of it's been led by some incredible technological change, whether it was the social media platforms a few years ago, AI now. And these are all very real dynamics that are out there. I mean, these are, billions and billions of dollars that are being spent on these chips. However, at the same time, ultimately valuation does matter and you need to see return on your investment. And I think given where we are in that cycle, along with the economic dynamics, the rate dynamics, the political dynamics, it's just natural that the market would start to look to shift away from that to more value-based sectors. We really saw this start to happen over the summer, in early July. There were a few days where there were very sharp moves towards value and small cap. It's been fits and starts since then. But that is something that I would expect to continue. And part of it is also just that large valuation gap between small caps and large caps. I mean, it's something like half the valuation, and small caps are making up, I think, the lowest percentage of the overall market that they ever have. So some of those dynamics could lead those to do better, and also a tiny amount of money that gets shifted their way could have an outsized impact on how the stocks perform.
Interesting. And so when trying to evaluate small cap stocks in this market, how can investors think about evaluating small cap stocks?
Yeah, so just picking up first on what Kevin suggested, the shift from growth to value and large to small has been sort of coincident. A lot of the same drivers, not all the same. Obviously, much of the growth in the very large companies has been driven by passive investing, more money going into passive vehicles that are investing in, for example, the S&P 500, and leaving a lot of the smaller companies behind. Again, I think there'll be some renewed investor interest in smaller companies, as they, in many cases, do provide a significant amount of value since they've been laggards for several years. It takes as much work or sometimes more work to evaluate a small company as it does a large company. And there are just fewer investors willing to do that work. Our analysts are doing that work. We expect to be rewarded for it in the form of better returns. And so we are seeing a lot of value in the smaller end of the market. Doesn't mean we're not going to buy, again, as Kevin said, larger companies, mid-sized companies. But to the extent that there's more value available there because those companies just aren't as well covered, or in many cases, they're more likely to be a takeover candidate, we think that's a pretty good place to look.
And can you just elaborate a little bit on the process for one of our research analysts who is covering one of these small cap stocks? Are they visiting these companies? Do they have relationships with management?
Yeah, I mean, very often the firm's relationship goes back 10, 20, 30, 40 years in some cases, depending on the company. But what the analysts would do is they'd look at all the published documents, 10Qs, 10Ks, read the footnotes. They'd read trade journals. They'd attend industry conferences. But yes, they always go and meet management where they live and operate. That's an important part of our process. We conduct thousands of meetings per year, either virtually or in person, with companies. We like to get to know them very well and to be prepared for when something is going to change. And maybe just, one example, get back to our aerospace team, our analyst, Michael Bergio, along with Tony Bancroft. They follow that industry with great intensity. One company, Triumph Group, which makes actuators, among some other things. Michael had recommended that company, thought they had a potential to sell some assets and delever. That happened. Stock responded. They still have some issues they're working out. They're a big supplier to Boeing. As Boeing works through its issues over the next couple of years, that could impact them a little bit. But when you get to the other side of that, sees a lot of upside in that stock in particular. And that's one that they visited both at their headquarters as well as seeing them at the air shows over in Europe frequently.
Great. Well, while we're talking about stock specifics, would love to talk more about some of your favorite small cap names at the moment.
Sure. Well, one, picking up on the last name that I happened to visit a couple of weeks ago, is the Atlanta Braves Baseball Club, based, of course, in Atlanta. Listen, sports are tribal. Sports assets have been great storers and compounders of value over time because they are economically resilient. Again, they cross generations. You're not going to be technologically obsolescent in most cases. And there are very few ways for public market investors to access the value of sports. In fact, there are only 3 or 4. One of them is, of course, the Atlanta Braves, which came public via a split off last year from the Liberty Media Group. Again, another owner operator, John Malone, who we've known for decades. But the timing of that split off and the reason for that split off was to make the Braves available to be acquired by an individual, most likely an individual who'd be able to capture the trophy value that you can't really access as a public market investor in buying that whole team. Right now, with the stock at $42, 62 million shares, you're paying roughly $2 billion for the team. The team, based on where other baseball teams have traded, is probably worth at least probably mid $3 billion kind of range, which will put the stock in the high 50s. And I think that will get realized in the next year or so. One other name, since we're just talking about small caps, that I also visited in Atlanta. That's an interesting one. It's probably called Mirion Technologies. MIR is the symbol. Stock is around $10, 200 million shares. And they make radiation detection systems, both for nuclear power plants and for medical settings. And two of the very large mega trends that we've been following is what we call the nuclear renaissance. In many cases, extension of the lives of nuclear power plants in the U.S. and building of new plants throughout the world for their climate friendliness, going to require more radiation detection equipment. Also, radiopharmaceuticals used to treat cancer is a breakthrough, and will require more of their equipment as well. This is a company that's going to benefit from both of those trends, amongst others, and we think it's pretty reasonably priced here.
Yeah, and on my end, in addition to the ones I talked about already, I would just note that one company, a little more of a mid-cap stock, but Bellring Brands, ticker's BRBR, it's around $60 or so. This company was owned by Post Holdings, which is kind of a food holding company. Sarah Donnelly is the analyst who follows it. She knows the company inside and out. They had IPO'd Bellring, which makes Premier Protein shakes. A few years ago, fully spun it out just over 2 years ago. So fully independent now, and it's a growing category. I mean, I talked about some of the pressures in food. Growth is tough to come by. When you look at the data, if a company has volumes up 1 or 2%, that's pretty good. This company is growing low 20s right now, or high teens to low 20s, depending on the time period. So they've got great growth, a lot of distribution opportunity. They and Coke with Fairlife are kind of the 2 biggest brands. I think it'll continue to do well. It's on its own, but back to the industry consolidation point, it would make a lot of sense for somebody to own that stock as well, or the whole company.
Great. Those are some great examples, and it'll be fun to follow along. So just to close this out here before we move over to our audience Q&A, are you thinking about making any adjustments to your value portfolios to balance potential short-term volatility with long-term growth prospects?
Well, we're always making changes. We're always obviously monitoring portfolios and looking to maximize returns for the lowest risk. And so, I talk about sports ownership in the NFL, and the NFL being the most exclusive club in the world. We like to think that getting into our portfolio is a pretty exclusive club too. We do a lot of work. We've got the companies that we put in there have got to meet a lot of hurdles, and we like to own them. Ideally, we'd love to own these companies forever, as long as they can compound their private market value at acceptable rates over long periods of time, and that we can continue to own them with a margin of safety. So, we tend to have pretty low turnover, low activity in the portfolio. But again, the world changes, and we're always looking for new ideas.
Great. And earlier you mentioned, sorry, Kevin, anything that you're thinking about as you're managing portfolios?
Yeah, I mean, look, I think that we have our process, we have our philosophy. That said, we try to stay flexible. I mean, we've got our areas of core competency, companies and industries we know really, really well. So a lot of our ideas are going to be drawn from those wells based on how the stocks are doing, what we think likelihood is of realizing a catalyst, et cetera. However, we're always trying to expand out. So when we hire new analysts, we'll have them sometimes look at new sectors, adjacent sectors, so some areas that traditionally haven't been a bigger part of portfolios. Healthcare can be one of them. Regional banks can be another. We've got analysts looking at those sectors, and over time, I think they're going to filter into portfolios.
Great. And you just touched on kind of this idea of, staying flexible, but earlier we talked about the importance and sometimes difficulty in maintaining discipline in a value investing approach. So how do you, as a portfolio manager, kind of find that balance?
Yeah, I mean, I think it's in some ways what I just talked about in terms of making sure you're investing in things but always growing that circle of things really well. And I think also this idea that we're not going to be wed to just because we're value investors, low PE, low price to book stocks. We're not going to be wed to certain sectors that are traditionally thought of as value. When you look at benchmarks, that's usually energy and financials, for instance, which we are actually kind of underweight versus our value benchmarks. We're going to be flexible. We'll look at technology companies. We'll look at those, we'll look at energy and financials and really everything. But we're going to try to go not what's hot now, but where the puck's going and where we think we can realize value over the next 2, 3, 5 years.
Yeah, and I would just said, being successful in this business also means admitting when you made a mistake, and we make plenty of them. But recognizing that earlier, taking corrective action is a skill I think that we have, and it's hard to learn. But we certainly try to be right more often than we're wrong, and that's generally been the case with the help of our team.
Great. Thanks. Now I'll open it up for Q&A from the audience. It looks like we already have a few questions in here. So first one we have is, how do you balance identifying deep value opportunities with the risks of value traps in today's market? How does PMV with a catalyst differentiate your investment process?
Yeah, it's a great question. Avoiding value traps is paramount for value investors because you don't want to own melting ice cubes where the value just continues to dissipate over time. I think having that option of a catalyst is really key, and knowing when things are happening in industries. And even with family-controlled companies, there can be catalysts that happen because that can thwart a catalyst, but that could still happen. We've got, TDS, US Cellular going through some things right now as one example. But that's really the biggest way, is just looking for that catalyst that can surface that value and having a discount that's deep enough.
When Kevin mentioned Paramount, he wasn't making a pun, I don't think, by the way. But Paramount obviously is a situation that's been deep value for a long time, and multiple catalysts. Obviously, one of them probably going to be realized here with the closure of the investment by Skydance in the next several months. But more to come on that situation.
Great. And in what ways do you account for political uncertainty and regulatory changes when constructing and managing your stock portfolio?
Yeah, we talked a little bit about this earlier. It all goes into the hurdle rate, the margin of safety that we require to get involved with a security. And again, to the extent that you've got a business that relies on a government regulation or law that can be changed by a change in government, that poses more risk to the business, and that's what will require us investing with a higher margin of safety. Now, of course, we're also looking for the other side of that coin, which is that there are opportunities to improve your business with the help of government, whether that's some of the spending that's come along with the Inflation Reduction Act, or patents or other things that provide moats for certain companies.
Great. And then we have a question about the decision to pursue a CFA charter. So for someone interested in the investment industry or becoming a portfolio manager, how should someone think about whether or not to pursue the CFA?
Neither of us have one, so I'm not sure that we're the best people to ask. But look, I think getting training is terrific, whether you go to business school undergrad, MBA, CFA, it's all great. But ultimately, if you want to really learn, do some research, open up a 10K, try to build a financial model, look at a product a company makes, and buy a stock. Come up with a thesis, buy a stock, see how it does, see how your thesis plays out. And especially if you lose money, that's the best way to learn.
Yeah, and read things like the letters of Warren Buffett, and of course, anything by Graham and Dodd or some of the other great investment publications that are out there.
Great. And then on the topic of educational background and preparation for the industry, one of you has a systems engineering and political science background.
It's two different. I'm systems engineering.
Political economy.
Political economy.
Got it.
Yin and yang on that one.
Okay, so how do your backgrounds before your time in business school and investing help you see investments from different perspectives?
Well, from an engineering standpoint, I never actually practiced it. I took it in school. I was an investment banker, as Chris was before business school. Look, I think engineering helps to think logically. It helps to just be comfortable with numbers and math, which you obviously need in this business. It can help to some extent just understanding certain technology that companies use and employ. But I think really beyond anything, whatever you take in undergrad, I think the most important thing is just reading those annual reports, getting to know companies, understanding how they actually make money, unit economics, what's the size of the market, how fast is it growing, how big can it get, what kind of competition is it going to attract, what are the barriers to entry, really thinking through all those things, whether you have a liberal arts degree, engineering degree, business degree. Any smart, hardworking person can figure that out if they apply themselves, in my opinion.
Yeah, I don't know that being a political economy major qualified me to do anything in particular, other than to ask a lot of questions. And I think that's important. Curiosity is an important part of this job, being willing and anxious to keep peeling back the onion, and anything that we look at is essential. And communication is certainly something that was emphasized in my undergraduate experience, and the ability to communicate your ideas in both written and verbal form is important.
Great insights. What areas or trends in the balance sheet do you identify specifically for value investing, or is it dependent on the industry and sector landscape?
Yeah, I mean, it certainly depends. I think on the industry, obviously, in financials, balance sheet analysis is a lot more important than, say, for a cable company. Obviously, we are looking at elements of the balance sheet. I focus in particular, as I alluded to earlier, on the capital structure, in particular on the tenor of the debt stack. Many of the companies I look at tend to be a little bit more leveraged, so we're spending a lot of time on that. And then, of course, ultimately, what's the cash flow? What's for an individual company, the working capital intensity can be important. So we're looking obviously at all those things.
Great. Okay, I think that was our last question from the audience. So thank you both for being here.
Thank you for having us.
Thanks.
Thank you to everyone who joined us. And we will follow up with email with some more information about the firm. But if you want to learn more about our solutions, or how we can help you manage your investments, feel free to email us at invest@gabelli.com.
Kevin Dreyer and Chris Marangi are Co-CIO at Gabelli Funds. This podcast is an excerpt from Gabelli TV that appeared on September 20th, 2024. Gamco is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of June 30th, 2024, affiliates of Gamco Investors Incorporated beneficially own 31.15% of Atlanta Braves Class A, 5.94% Class C, 12% of Paramount Class A, and less than 1% of Class B, and less than 1% of all other companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other Gamco officers, analysts, other employees, or the firm as a whole. Because the investment personnel at Gamco and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain Gamco personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI or 800-422-3554-914-921-5100 fax 914-921-5118 info@gabelli.com.